wrapping up in the next 50 minutes or so. Almost 100 slides, but I go pretty fast. Okay, here we go. All right, so investors don't put money into ideas. If you say you have the best idea in the world, that's all well and good. I'm sure they're interested to hear about it, but investors are there to make money. They put money into your businesses so they can make money out. It's plain and simple. To them, in many cases, you're just simply a piece of meat. You're somebody that is there as a vehicle rather than stocks or bonds or anything else. Okay, let's try to see if we can get some returns. So if that's the idea, they look at you like a black box, money in, money out, then you have to describe the process. You have to describe how you derive your revenues, what sort of profitability, profits you make, what your cash requirements and needs are, how many people you need, how quickly you're going to go through cash, how much cash you have left. All this kind of stuff is your real business plan. And they expect you to be able to show what I call financial literacy. You have to be able to speak the language of finance. You have to know what these terms mean, and you have to know them cold. So when you're presenting as the CEO of a company, you have to know this stuff cold. You cannot go off and say, oh, here's my finance person. They're going to present the numbers. Because you're running the business, you need to know this stuff, and you need to know it well. And you need to know it well. Typically, the thing that's most often used to describe your plan, at least initially, is a 5-year, called a P&L. P&L stands for profit and loss. It's a simplified income statement. And frankly, year by year. So the purpose of this presentation is to allow you to build out that presentation from scratch. Now, why 5 years? It's 5 years because most investment funds, when you talk to a venture capitalist, they took a year to go ahead and raise their fund. Their fund is alive for 10 years, and they are responsible to the people that gave them the money to have some return within a 10-year period. But you might be talking to them, after the fund has been around for a year or two, and they want to make sure that, you are able to have an exit sometime within that period. So not actually towards the end, somewhere in the middle of the harvesting period. So 5 years is kind of a magic number. It allows you to get the company rolling and growing. And so we can see what steady state looks like. So that's where 5 years comes from. So from a financial perspective, if you ever took accounting, you're often told about these types of financial statements. You can generate a balance sheet, which is basically your assets and your liabilities, your cash and what you owe. You can build an income statement, which is kind of an ongoing video of what you are doing over a period of time. And then the income statement has a cousin, which is a cash flow statement, which worries about the actual money that you have in your bank account or anything at any given point in time. And you want to make sure that that never runs out. For the purposes of speaking with investors, luckily it's only one. So what we're going to try to do is to minimize your work. So know that you don't need a balance sheet, you don't need a cash flow statement. We're going to focus on an income statement. Now, an income statement has a basic structure. It starts off with revenue. How much money are you bringing in? Simple enough. Minus your cost of goods sold. That is the monies that you need to produce that thing that you're selling. And I'll describe that. Also called the variable costs. And those two, the revenue minus the cost of goods sold, is your gross profit. Gross profit. Now you take that gross profit and you subtract out your expenses. And these are also called fixed costs. So this is what you spend in engineering. It's what you spend in sales and marketing. It's what you spend for overhead, like management and legal and all that kind of stuff. So those are fixed costs, and that's your net profit. So take a look at this. If you understand it at this point, we're halfway there, because frankly, all we're going to do is just work on this equation and to break it out. Know that in a lot of accounting classes, you deal with stuff that's considered to be below the line. By the way, for net profit, you may also hear operating profit, same thing. You also might hear EBITDA, which is kind of a funny expression, earnings before depreciation, interest, taxes, and amortization. So just know that net profit, all this other stuff though, like interest and depreciation and all that, you will see in some income statements. Here, we don't have to worry about it because all the investor is looking for is your contribution on an operating level. How much can you make in your day-to-day operation of the business? So what that means is all you need to solve is three things. Your revenue. Okay, well, that's pretty straightforward. How much money are you bringing in at any given point in time? How much does that revenue cost on a per unit basis? That's your cost of goods sold. And then what are your fixed costs? What are your expenses? And so we'll go through and we're going to break those out individually. Now, what that means at the end of the day is you will be producing a P&L that looks like this graphically. This curve, I love this curve. In the vernacular, it's called the Valley of Death. What it does is it breaks down the stages of an early stage startup. So here you are, you start off at day zero, you're cranking along, you're doing your customer discovery, you're deciding what sort of a product to build, you build your prototypes, you put it in customers' hands, and then eventually you're happy with it. When you're happy with it and your customers are happy with it, you go into and do a product launch. The expenses increase. And so the curve dips down because you're spending money on marketing and sales and getting out there and promoting and so on. And you're bringing in some revenues to offset all that. Great. Revenue, but you're still losing money. Now, at some point, you break even on a periodic basis. So you may break even one day or 1 week or 1 month. That's wonderful. And what that means is you've turned the corner and you're beyond the valley of death. Not everybody turns the corner. A lot of people and crash. So depending on statistics, 80, 90% of companies do not make it through the valley of death. We hope that you all do, and we're here to encourage that. But once you turn the corner, you're then digging yourself out of this hole and eventually getting to cumulative cash flow break even. This is the minimum amount of money that you need to have or raise in order to get the company through the valley of death. And then from here, you're off to great things. So this is what your P&L will look like graphically. And we're just going to translate that into numbers. So the idea is to work as much as you can over here, to not open your spreadsheets. The first step is not to open Excel. It is to work on all of your assumptions. Second thing I want to say is this is not official accounting. This drives the accounting people nuts. So they all want to see everything in the right place and everything that's going on. No, because what you're doing is you're telling a story. And so the fact that something is not exactly where it needs to be for reporting purposes, GAAP means generally accepted accounting principles. And IFRS is the European equivalent of that. So this is not official accounting, it's unofficial accounting, but you just have to account for everything. So, God, how do you do that? Because you're basically predicting the future. You're staring there, and I see a lot of people open their Excel spreadsheets and stare at the blank sheet and go, oh my God, where do I start? So we're going to show you how to predict the future with little or no evidence and trying to guess. And then you have to go present in front of investors and tell them that your guesses are valid. Oof. So we're going to do that by telling a story. So your financial projections are your story expressed in numbers. So we're going to build out the story first and then translate that overall. So the steps are, first off, you build a timeline, you label out your assumptions of how the business you think is going to look. You can do this on a whiteboard. You can brainstorm with your team and build out a timeline. Second step is you assign some unit economics to that. You think about what's a unit? What do I sell? What's one thing that I sell? And it might be a software license or something like that, but we describe what that is. Then we take our timeline and our unit economics. We built a short-term model because you could probably have some visibility into what's going on in the next year to 18 months. And then from that, we go off and we do the scary thing, which is to build a 5-year model. So that's it. So step one, sit down on a piece of paper or a whiteboard or something and then start to figure out some of your timeline assumptions. Now, there are classes that you would take that would describe these in more details, but just let me give you some of the categories that I would expect. What type of revenue model do you have? I'll show you that in a minute. What kind of market type are you going into? Who are your key customers? How are you reaching them? What are your sales channels? What's your pricing structure look like, both wholesale and through channels? What are your manufacturing costs? What are your products and services? What sort of growth milestones do you have? When are you launching new product lines? What geographies are you going into? What's going to be your headcount requirements? Well, how do you launch and so on? So this is an early budgeting exercise and just some of the things you need to consider. One way to simplify it is I try to think of things through stages. And so if you think about the methodology, often you'll hear Steve Blank methodology or customer development methodology. We talk about a problem solution fit and all the customer discovery and prototype. It's the first phase of that valley of death. What do you need to do to get through that? And you go through product market fit, which is the next phase. What do you do to get through to customer validation? How do you get to market? What's your full product look like? What are your launch plans? How do you build out your sales channels? And then growth phase, what goes on. And so each of those will have a timeline, and each of those will have different types of revenues and expenses as you roll along. So with all that, you start to put together some timelines. So here's one example. This is a super simplistic timeline, and you can see it has multiple elements. First off, I've labeled things out. Q means quarter being 3 months. So you can do it month by month. That's cool. And eventually you probably should, because you want to have that kind of granularity. But just simple first pass, let's take a look at a quarter. And I've labeled out here 8 quarters, which is 2 years. And I'm going into production. I have some orders. I do my second production run. I do a cost reduction. I'm in full production. Then I have 50K per month shipments. I have some seed funding to get me through here, some Series A, some Series B. We'll describe that. I need some people. It's a simple timeline. Here's another timeline. I kind of like this one better because it goes through, and this one's labeled out by months. I stole this from somebody else, so it's a little old, but that's fine. You put your own dates on there. But here's your product milestones. Here's your market milestones. Here's the company milestones. Here's some funding events. Here's that customer development method that I like to do. So you can talk about what your problem solution looks like and what happens here within this portion of the timeline. And then when you cross over into something where you found a product that is worth building, you've sampled your customers, you've got a prototype, you're maybe making first revenue, you go into customer validation, which is trying to develop a repeatable and sustainable or scalable sales process, and you achieve product market fit. This has its own set of expenses. You then go into big growth mode, and you wrap up your business model, and you raise money and launch into sales, and then you have a mature company. So this is another way to carve it up and do a timeline overall. I deliberately did not get specific on a timeline, because what happens is that everybody copies what I do. You need to build your own. So sit down on a whiteboard and design your own timeline. What are your milestones? How much money? What are the major buckets of expenses? Where are your revenues coming from? Build it all out. I'm going to show you then the next step, which is actually how to build a specific P&L. And I don't have one with me. Actually, I do here. I won't get it, but I'm going to do the story of a clicker, because normally when I give this live, I have a clicker with me. So New Prodco, not a very exciting name, is going to build the world's best projection clickers. So first thing for me, I build out a timeline with some assumptions. So for me, here's my assumptions. It's a product. It's not a service. It's not software. It doesn't have any software with it. It's just simply a thing. It's my clicker. So therefore, it's a one-time sale. It is a resegmented market. If you're familiar with that term, it basically means it's not an existing market. However, there are clickers out there, so it's got some tweaks. It's got a brand on it, Logitech. It's got some extra features on it, so I have to do some education. I'm selling directly to consumers. I'm doing that through channels like Amazon. I am not building a factory, so I'm using subcontract manufacturing. And it's going to take me 3 months to get to market. No, I'm sorry, 3 months to develop my first prototypes, 3 months to sample my customers so that my channel knows what it is and how it works, 3 months to get to first production. I'm going to sell initially in the US, and then I'm going to move internationally in 2 to 3 years. This is just one example. You build your own. So with that, I start the company, first prototype, I sample, remember 3 months later, first production 3 months later, I get some profits on a unit basis, I enter and I have some production milestones that I want to achieve, and I'm going to go international in second quarter. This is super primitive. I suggest you design this out to be representative of your company. Okay, so that's step one, my assumptions, my timeline. Second thing is my unit economics. So this thing has got a price, a cost, and has some profit. So it's super important for you to understand what your unit is. It might be a contract, and hang on, I'll start here. It might be a specific contract. It might be not one unit, but an entire shipload, or it might be a purchase, like a cell phone, mobile phone, and then some subscription revenues afterwards. Whatever that thing is, you identify as a unit, describe it specifically, understand its pricing and its variable cost, and then you're on your way. I'll show you what a product. This is the simplest version. So first off, if I were to look this up on Amazon, here's the actual listing. It's $34.99. Know that $34.99 is not what I would make. It's what Amazon receives as revenue from a customer. They then pay me for the privilege of hosting that. And so Amazon in this case has a channel margin, and everybody in between, a channel margin of 19. So I, at the end of the day, receive 16. This is very typical. So be mindful of all the things that happen when you go through specific channels and who collects revenue along the way. When you're building a P&L, you don't have control over the end retail. It might be a suggestion, but they can price it up or down depending on exactly what they want to do. But they then pay you the $16 that you then are going to mark out in your P&L. So we have a price, 16. Now, this thing has a cost associated with it. It's my variable cost. It's the cost for that unit, also called COGS, you'll hear, which is cost of goods sold. So, yep, it's a thing. It's got a housing, it's got a laser, batteries, wireless module, all that. So it costs $7 for me to build this and to have it in my warehouse and get ready to ship out. So this one's pretty simple. There's my ASP, by the way, that's another acronym, average selling price. Sometimes it's higher, sometimes it's lower, but I take the average, which is 16, minus my cost. So I have a unit profit of 9. I divide my profit by my revenue, I get a margin. So my average margin in this case is 56% and change. Is this good or bad? Because we're in a group setting here on Zoom, I'm not going to call on people, but just to say that you don't know yet, and it depends. So there's a couple things that weighed in. Now, you can do a sanity check. First off, you can take a look at industry standards. So other people, maybe in the professional hardware products for things like projectors and other clerical items, things like that. If they're in the 50s or their 40s or 60s, you're in the same range. But at the end of the day, too, you also want to make a profit. So you want to make sure that this is gross profit. You want to make sure it covers your fixed costs. So here we go. I'm done. Unit economics. You would do the same thing in your slide deck to an investor. Often there's a slide that says, here's my unit economics. I'm selling this good. It cost me this much. On every single unit, I am making this much money, and here's my margins. So cut and paste this, do your own version, and that becomes part of your investor deck. Once we're through with unit economics, I'm on to step 3, which is actually building out a P&L. So I know how much a unit is. I have a timeline, and now I get to, this is the scariest part of building any P&L, particularly for people with an engineering background, because you're trying to predict the future. Oh my God, how am I going to sell? But you have to take a stab at it. So basically you take your timeline, the type of business, typical growth curves, which I'll show you in a minute, comparables, you can see what other people have done. And once you throw some numbers in there, you see if I'm going to be okay. So I'm taking the brave step of saying that I will have 0 sales in first quarter. I'm going to do some samples in second quarter. I'm going to start my production in third. I've checked with my customer base. I think I can sell 10,000. Note that I don't have individual units. Often, for this point, the details, individual small units don't matter. You can do it grossly, like in thousands of units. So I'm going to have 10,000, 40,000, ramping up, 75, 110, and then it gets to be fairly linear after that. This is my timeline, and this is my curve. Yours may be higher, yours may be lower, yours may have step functions, whatever it is. Take a stab at your first 2 years. First 18 months is a minimum. Do it by month if that makes you feel more comfortable. And off we go. Okay. So once we've taken a leap into the deep end of the pool, now we start to build everything out. So I have an average selling price, which remember is $16. It starts at 8 because I'm sampling. In some cases, your pricing may go up or it may go down, but you can play with that. I'm holding it steady just for the sake of the math. And there we go. So I multiply my units sold times my price is my revenue. And so I'm making 1.2 million up to 3.2 million here in my, at the end of my second year. Straightforward? Good. Okay. Now we take in our cost of goods sold. I already know what that is. So initially it's going to be higher because I'm sampling and I have small unit lots. But then my manufacturer has this to me at $7. So there we go. I multiply out my units times my unit cost is my cost of goods sold. And I subtract those two and I have my gross profit. So I'm running a small loss here and then I'm starting to make money overall. Again, this is simply gross profit. It doesn't account for anybody, my expenses, the salary, the building, the overhead, anything else yet.
All right, can I ask a question?
Yeah, sure.
I have a question. Could you please share from your practice, what is the forecast accuracy based on these sheets, I would say?
Accuracy?
Yes, forecast. When you're making this forecast and in fact you're getting 70% of these figures or more or less.
This is only a guess. But what you're doing is you're gathering enough information through assumptions that you can explain it. So what I do then is I go back and I show this to other people and I tell the story and they go, well, is that right? I think you're too aggressive, or I think you're not aggressive enough. And just through testing, you can common sense your way through. The important thing with investors is you have to explain this with confidence. You have to be able to stand up to them and basically say, yes, this is what I believe and this is why. Now, is it going to be accurate? Who knows? Things change. But you have to put something down on paper. You can't get away without doing it.
Thank you.
So I answered it sort of around here. It doesn't have to be 100% accurate. It will never be 100% accurate because you can't predict the future. It's a forecast. So do your best. Good question. Okay, so I've taken my stab at it and here's my gross profit. And I have some margins and it turns out my margins are flat. Sometimes margins increase, sometimes they decrease. But when you have a number, you'll be able to tell that story again to your investors. Okay, so now we're done. This is often called top line. top line. So we've gotten there. Then now we have to add our fixed costs. So we're going to do salaries and expenses by department. So typically the way it breaks out is I have my engineers, and in the accounting world, it's called R&D. I have my sales and marketing people. I might have operations, like if I'm running a warehouse or I have manufacturing or something like that. In this case, I don't, but I just wanted to put it down here just in case you have something like that. And then I have, or support costs or whatever else. And then I have G&A. These are the general buckets that are used. If your business is different, like if you have major legal expenses, then maybe there's a legal line item or something like that. Or shipping is a big part of yours. Maybe have shipping as another line item. But those the three that most count are R&D, sales and marketing, G&A. So the biggest part is salaries. So you're going to take a look at headcount. I'm going to do the simple version of this and just basically say that you can do a headcount where you say this person is in here and this person gets paid this much, and that person is works at the front desk and they get paid this much, and this person works in the manufacturing floor and they get paid that much. That's fine. Eventually you'll have to get there. But for this purpose, often what I do is just say everybody gets a general number. So in the US, Canada, Western Europe, I use 100,000 per person. Rest of world, like some of the Asian countries and so on, I use maybe 50. Ukraine might be, let's say 75, something like that. You're not quite at the super low level, but something in here. And then after you're profitable or after year 5, those numbers come up.
I have a question.
Yeah.
I'm sorry for interrupting, but I just have a question from our practice. When we were doing this P&L, we have developers in our team as founders. So when we were thinking about where to put, for example, salaries, we don't know if they should be mentioned in staff cost or in R&D if we're still building the product. You may answer that question like in the end, but it's interesting.
Actually, no, that's a good one. And then I'll answer that in the next like 3-4 slides.
Okay.
Yeah, like where do you, this is kind of where do you put people? And the real answer is at the end of the day, it kind of doesn't matter. You don't have to be exact about it as long as you account for everybody. As long as those expenses end up somewhere, and then you would explain why. But with that in mind, let's start to go through then some of the details. Okay, so salaries, yes, and then non-salary expenses. So your engineering group will have some expenses on servers and maybe outsourcing if they have some contractors outside. Marketing and sales will have marketing campaigns and trade shows and other expenses. If you have operations, which I'm not counting here, you may have some of that. And then G&A is your general administrative, is all your overhead. So that's management. That's usually considered to be the people that don't do anything. That's terrible, isn't it? That aren't engineers, that aren't building something, that aren't marketings, that are marketing something. These are the people that sort of oversee everybody else. Now, of course, your CEO is super important. You got to have one and all that. But it's kind of a joke. That's your overhead. So let's go department by department. So I'm going to do this 3 times. So to answer your question, I would typically, if you had founders that were working on engineering projects, I would put them in the engineering budget. I would have them here because they're contributing and they're actually doing work, and that's your R&D expense. A quick aside, in some places when you're applying for grant money, that grant money might be just for engineering and R&D expenses. And so you don't want your founders sitting over there in your overhead budget. You want to actually have them here so you can account for them, and then your grant money would be applicable for this. So it's typically better, if you have a choice, not to put people into overhead, but to put them in the operating departments. Okay, so here I have 1, 2, 3, 4. It's pretty small. One engineer for 100,000 a year is 25,000 for that quarter. And then I simply label it out. So there's a whole exercise and maybe another topic about how big does your engineering department need to be. You guys figure that out with your engineers and label them out. And again, you can do that by month if you wish. And then they need other stuff. So I'm going to buy them some tools. I'm going to use some outside contractors. They're going to travel a little bit. So if I add my salaries and all these other expenses, then I have my overall expense for my engineering department. Second, I have marketing and sales. And so here I'm going to start off with a couple of marketing people. Usually in consumer facing businesses like my clicker, I'm going to have more marketing and sales. So, and then everything adds up. Again, I'm paying on the same level. You can see why this simplifies stuff if I just have one number. And then I'm running some campaigns. I have some travel and so on. So there's my marketing expenses. General administrative. So taking no salary to start and then a small salary to begin with and growing out over time. There's my legal numbers, which might be contracts, might be patents. Oh, here's patents, IP filings, intellectual property, that is. There's some travel, and there's my G&A expense. So I go through the exercise, I add all those up, and then here's my P&L. So I have, you've seen this before, up to revenue line item, up through COGS, revenue minus COGS is gross profit. I add in all these, here's my expenses. I take my expenses and my gross profit minus my expenses, my net profit. And you can see here, after I've accounted for my expenses, I'm losing money in my first 7 quarters. So, and I break even after that. Very typical. I mean, remember Valley of Death, you're going to be running at some sort of a downward slope over time. And if I add all those up, if I add up all those losses, then it looks like this. So I have a cumulative loss that grows and I get deeper, and the farthest it goes down here in Q7 is 1627. So that's the minimum amount of money that I would need to raise or account for or receive in grants or whatever in order to make my company viable.
I have a question. So here you elaborate on the point that we need to ask for the next stage as we're gonna reach break even, right? But often, like in early stages, we just need to, let's say, calculate what we need just for some certain milestone, and it's not necessarily the break even point. Am I right?
Yeah.
Okay.
So let's say you had an extended. So first off, you would never ask for the 2 million here. You'd ask.
Yeah, that's the point. Like you will never ask it in the very beginning that you need 2 million.
Yeah. So you want to be able to have. You'd like to have up to 2 million in the bank right away. That would be awesome. But maybe you have some grant money here, and then if that's $500,000, then you need to raise another 1.5. So this is not a fundraising strategy slide. This just tells you exactly how much money you need. And then there's a whole strategy behind it, which is another lecture for another day. Cool. Did I answer that?
Kind of, yeah, but just one last question. So, but if, for example, I build this up for myself, right, this table, so I don't yet show it to anyone. And now I need, let's say, to go and I have just, I don't know, 10 grand in my pocket. So I need to investor and ask, for example, to last for the next, I don't know, year, let's say. So what then I'm gonna show to him? Because can I show that I will still be not profitable in the end of the next year, or I make this up brighter and then in the end of, yeah.
You show them both. So what you don't say is give me money and I'm going to lose it over the next year. Thank you very much.
Yeah.
That would be bad. What you want to do is to show them a longer term picture that says, if you give me this much money now, I'm going to make this much money for you later.
But we can like break it into milestone and okay.
Sure. Yeah. So, they're going to have some expected return, and you can ask them what that is. I mean, you always hear about, I want to return 10 times the money. If I invest $1 million, I want to see 10 million back, something like that. Not everybody has that same attitude. But you have to show them that you have the prospect. Let's say it's 10x. You have the prospect of making, if they invest $1 million, that they can make 10. And if you can't show that, they're not going to invest. But this is our short-term model. So I'm only doing the first 2 years because this is the simple one. This is where you have enough visibility and you kind of feel it. You can talk to the customers, you kind of know how things are going to roll out. So we've just done a 2-year version, and now I'm going to shift to a 5-year version. So my 5-year version, we can do a couple ways. So we can either do bottom-up curves, just like we did, right? Or I can cheat, and I'll show you a cheat way to do it as well. But the bottom-up curves, you have to be able to predict your demand and your expenses, know what your industry curves look like. You maybe have somebody else in your industry that has some history that you can use, and that's great. The other way is estimate year 5. So you start here and you work your way backwards. So I'm going to do this one first. Okay. So what I can often do is just, this is a little sloppy, but year by year, I would say I'm going to grow, not 100% per year, but just a little bit underneath that. And so my curve itself is pretty steady. Maybe I'm launching a new product line here, but you can go ahead and predict what things would look like. And I'm going to show you some curves for different industries towards the end, but this is a typical way that somebody would do it. And if you have other examples that are out there, that's fine. So what this means is I was at 8.4 million my second year. And through this growing methodology, I'm at 56 million in my 5th year. I'll show you some examples of whether that's good or bad, but then it allows me to build out my full P&L. So that's a simple way to do it. The other way to do it is to say, I have no idea what's going to happen in year 3 and 4, but I have a goal. I'm going to try to build my company out to be as large as others in my space. And so these are Silicon Valley numbers, but in year 5, if someone brings a plan in here that if you're less than $20 million a year in year 5, you're too small. Somebody could not make the returns. Like the investor with 10x, they couldn't make 10x. So less than 20 million, that's fine. It's a nice business. Congratulations. It's great. Get some grant money, off you go. If you're between 20 and 50, the returns start to come in. The math starts to work. And it's interesting. So if you have a company that can grow to that level, and by the way, these are all tech companies for the most part, grow to that level, it's interesting. You will be able to attract, smaller investors, angel money for sure, things along those lines. If you're between 50 and 100 million, it's very interesting. It's hard to do. It's difficult to grow that fast, but if you can get to be that big, then you might be able to attract, a whole lot of investors to that. And then lastly, if you predict you're over 100 million, people think you're smoking crack. You're crazy. It's crazy talk because it's really, really, really hard to do. So, that's unicorn territory, and you might get there. It'd be great depending on the industry, but you have to be able to explain it. So one of the cheat method is to say, well, I'm going to be, not 50, I'm going to be a little bit better than 50. Okay, so I put a number in here and then look at everything else I have to do. So with all this other stuff that's in here, my R&D expenses, my sales and marketing expenses, my G&A expenses, I would apply something called the zone of reason. What does that mean? Zone of reason is what else happens in the industry and how you're going to run your company in year 5. And so you can use this. I'll show you how in a minute, and get all of your expenses down. So I have my gross revenue. I've calculated, I already have my COGS. I know what that is. So I have my gross profit. That's relatively easy to calculate. And then all these guys, I come up with these percentages, apply the percentages to the revenue number, and then draft them out. And then that becomes my net expenses. So here are some zones of reason in general. You can see they're pretty broad, but this is a consumer-facing product. This is a business-facing product. So in a consumer-facing product, because I'm building a brand, I have higher, and I'm reaching out to individual consumers. I have higher expenses rather than selling to businesses. R&D will be lower than B2B, which will be higher because these are typically more sophisticated products. And my G&A, my overhead should always be in the neighborhood of 10% plus or minus. If it's higher than that, you've got some problems. So these are just general ideas about how you can build that out. And there you go. So I've got this done, and then I add in years 3 and 4, and then I do a double check to make sure that they're all reasonable. And that's it. So either I've built this out using my pre-existing curves, or I built this out using this 5-year zone of reason cheat method. But basically, I would show this to an investor, and I would say, in summary, it's a $50 million business. I'm losing money for the first year. I'm breaking even in year 2. I'm steady state profitable after that. My expenses are all within the zone of reason for this type of market. And I'm looking to raise $2 million at a minimum. So there you go. We're done. So the rest of this stuff that I'm going to show you now is what to do. Now that you've got here, because this is all the work, now what do you do? So first off, when you're going to present it, you simplify it. Notice I've gone from thousands to millions. Where am I here? Okay, yeah, I've gone to millions, which makes it easier to read. I've simplified all this out, so my expenses are a simple line item. I don't need to have the breakout, and I can see my net profit overall. I've also narrowed it down to 1 decimal point, so I don't need to round it out to all the individual decimals. No one cares, because remember, this is just a big picture estimate, so you don't need all the details. So simplify, make it easy to read. And this is honestly pretty much what would go inside my investor presentation. So once I have this, then I start to go through and do my sanity checks, because I've been making stuff up as I go, but now I want to see, does this look like others in the industry? Are there any strange jumps or gaps? Notice all the curves here are pretty straightforward. I don't double or triple like crazy talk anywhere in the middle. How quickly does the company get to break even? I know that. How much money do I need to raise? Is the business big enough to care about? Yes. And does this generate sufficient returns? Well, that's for an investor to decide, but the answer is probably. So a product business will have a certain look. So I have high revenues, I have medium cost of goods sold, so I have medium net revenues, and I have a medium net profit. That's what a product business should look like. A subscription, this should be a software business. Software businesses will have very low cost of goods sold, and therefore the net revenue is high. Software, it might be 0 in terms of cost of goods sold. I have high marketing expenses, R&D, and so on. So my net profit is high, and that would look like others. And then, yeah, there's my software bill. I got these backwards. So you get the idea is that it has to check. I check whether it looks like a product business. It looks like a service business. It looks like a retail business. Each one of those is going to be a little bit different in terms of its shape of its curve. So I have a scalable business. It looks like that. I want to see whether I'm in an existing market where I have other competitors. I'm in a resegmented market where mine's a little bit different. Or I'm in a brand new market where I have a lot of education and a slow adoption. Mine's a resegmented market. My curves look like that. So you're going to do all these sanity checks because investors will do sanity checks. On my cost side, what do my costs look like? Do they decrease, increase, or somewhere in the middle? I'm a technology product and I'm doing subcontract manufacturing. Therefore, I should have decreasing costs. So I've done my sanity check, and now I can throw this stuff into a graph. I'm not a fan of graphs. I prefer the P&L table. And the reason why is because when I'm an investor, I can compare your company versus another company versus another company, because each one of those is going to have the same look. When I see a graph, I have to start figuring things out. Here, I don't even know what the units are. I don't know what these lines represent. I have to look down here and study it. I have to take a look at it and compare my numbers versus my graphs. Graphs are more work than you think. People think, oh, I have a graph, and people can see exactly what's going on. It's quite the opposite. So if you can avoid it, don't put graphs in your financial presentations.
Sorry, do you like pie charts?
Sometimes. Like
Okay.
for what? So pie charts are good for things like share of market. They're never good for revenue. Well, they're good after the fact. So if I have my P&L and then I say, here's my expenses. In my expenses, I have 50% in sales and marketing and 25% each in R&D and G&A. You know, a pie chart would be a good explanation. That's fine, but it's not your primary financial instrument. I'm going to do, I have 5 minutes left. I'm going to do a quick software. Oh, so that was it for me on the basic P&L. Any questions here? Think about what you guys are doing. And those of you who built this out already, hopefully you're going to make some changes.
One question left from the standard salaries, 50K and 100K, and you mentioned 75K per year for Ukraine. So I'm just wondering where are these numbers going from? Why such numbers?
It comes out like this. It's out of my back. It's a pure guess. I think if you for whatever circumstances you have, what industries you're in, you can justify and guess and justify. If you don't have those numbers, and if you want to put down individual salaries for somebody and do a more detailed spreadsheet, there's no reason not to. I gave because the quick and simple, dirty version.
Okay.
Yeah, I don't claim any accuracy. I did not go to the Ukrainian government website and look up average salaries or something. I was just the spirit here, the kind of the philosophy is it's done is better than perfect. It's much more important just to get something done and out there, and then you can argue all the details. But to be able to run through this first pass and kind of say, do I have a viable business? Is it something that somebody might be willing to invest in? You can do that in, we did this in less than an hour. So you could take probably an afternoon with all the research you need to do and to pull this together. And that's good enough. And that will get you in front of an investor, and then you can start to argue the details. Cool. But yeah, and that's a valid question. I mean, an investor would ask the same thing. Hey, you have 75,000. Why is that? So
one question: Do we need calculate retention and lifetime of client?
Oh, okay. Mm-hmm. So what I just did is I built out the P&L. Now for subscription businesses, there's other metrics. You would need the P&L to be sure, because that governs kind of what you need to do and how much money you need to raise. But then there's some metrics on goodness, and there's a bunch of metrics for subscription businesses. One is customer acquisition cost. One is customer lifetime value. One is monthly recurring revenue. One is average contract value. One is churn. So those 5 key metrics are things that you need to know. Now, once you build your P&L, you can start to derive those. And I'm going to show you a couple things, not directly customer acquisition cost, but a little bit more on SaaS models, because they're funny. So differences with subscription-based businesses. Subscription-based businesses, I'm using Dropbox. It's a good example. So Dropbox, I pay $99, well, now it's $129 a year upfront, and I get the service each and every year. They spend money to acquire me. They advertise to me. They give me some coupons. They do all what they need to do to acquire me. That customer acquisition cost is one measure. And then I provide them subscription revenues over the lifetime of my relationship with them. So that's a typical subscription-based businesses, but there's some subtleties in the way you do a P&L. Let me show you that. So there's, in fact, each one of these business model types, a product business is different than a service business, is different than a trade business. A subscription business, a marketplace like eBay or Etsy or something, a brokerage like a real estate broker, stockbroker, or an ecosystem which has it all. These are all different business models, and they'll be slightly different when you construct a P&L. But a lot of people do subscription businesses, so I'm just going to go through that. And again, you rely on monthly revenue and you worry about your customer acquisition costs. So here's how you do a subscription business. First off, typical subscription business will have multiple plans. You'll have a low-end plan, a medium plan, and a high-end plan. To do your revenues, you typically aggregate all of those. So your low-end plan might be 50% of your business, 25, 25. You take the moving average of that. Your average sales price is $10, and therefore your quarterly average is 30. Okay. You take a churn into account. So I start my period, my quarter, with 1,000 subscribers. I grow 1,020. I lose 20 subscribers. That's my churn. And now I have 2,000. 1,000 plus 2,000 divided by 2 is the average. Means I calculate everything based on 1,500. So I don't take the beginning, I don't take the end. I take the middle because that's exactly where I'll see the revenues from. Okay, so my revenues times my price is my average revenue. If you don't do it properly, you either over or underestimate. My next step is my COGS. COGS for subscription businesses are funny because a lot of the stuff that you would normally think are fixed costs show up for a subscription business. So this is the model that Salesforce and Dropbox and all these guys use. And they add up all the direct costs attributable to the production or delivery of the cost of goods sold. So all the hosting costs, the personnel costs, customer care, any third-party fees, any payment fees, all roll in. So my COGS for a subscription business, even though it's shipping something, it's not zero, it's all this stuff. And so there they are. And these all add up to 29,000. Cool. Step 3 is my fixed expenses. Remember, these are the 3 buckets. And so I have all my salaries and rent and advertising equipment. And there's a good breakdown of those in this one case. And so here I have my revenue minus my COGS minus my expenses is my net profit for this particular business. Subscription businesses are interesting because in raising money for a subscription business, you will go through and you'll calculate for your P&L a valley of death. And the valley of death may vary as a function of how much money you want to pour in to that business. So if you do the minimum here, you can grow at like 2 customers per month. This is out of literature. If you pour more money in, because it's customer acquisition costs, you can get 5. If you pour more money in, you can get 10. And so remember that valley of death that I showed you? From a strategic standpoint, maybe your minimum amount of money to raise would be here, but in subscription businesses, often in order to be the leader in your particular industry or to grab more customers or to win against your competition, you put more and more money in. And so the amount of money that you raise in a subscription business can be 10 million, 20 million, 50 million, 100 million, 200 million, 500 million. People raise insane amounts of money for subscription businesses. I just wanted to say that. So I'm out of time, and I just wanted to say that congratulations, we just did it. So we built out a full P&L. I should send you guys all certificates for being financial geniuses. And no, you're ready. So you get the idea. It doesn't have to be exact. When you run your business, it does. But to do an estimate of kind of what you're going to look like for the next 5 years, this is good enough. And this will get you to the point where you can engage with investors and you can tell a credible story. So thanks. I'm going to open the floor for any questions. And know that I'm going to send all this to you guys, and I'll take appointments if you want offline. So Anastasia, Nadia. I'll turn it back over to you guys.
Yes, thank you. Okay, so any question that we have, because as far as I'm concerned, I'm not sure that on Facebook we have any questions, but I will remind that guys who's watching us on Facebook, please put your questions in the comments so I can address them to Rick, if you have any, of course.
I'm gonna throw one in if nobody has questions.
Yeah,
Hi, Rick. Good to see you. Good to hear you.
Thanks.
We're recently thinking about the fact that in our business model, it's not the initial product that is actually going to be bringing the revenue in and making the bulk of the money, but it's a product with which we're getting the market share and sort of getting our place in the consumer environment of our customers. So with that in mind, do we just follow the same template and pretty much produce one P&L statement for the basic version of the product, so to say, and then at certain year, let's say at year 3 or year 4, we can say that, look, based on our assumptions and projections, based on the knowledge we have right now, this is what's going to happen, and that's where we can start rolling out the second version of the product, which will bring significantly more revenue from the same audience. But then the overall sort of projection span needs to be increased, I guess, to like 7 years to show that this is how we project this second version of the product evolving.
Okay. You asked a couple things there, so let me break them down. Bye, Ruslan. Nice to see you, by the way. First off, 5 versus 7. 5 is a minimum for most investors, although somewhat might be able to get you by with, allow you to get by with 3. There are certain industries or certain circumstances like yours where longer is better. And if you're able to predict things out, that's fine. I'll give you one simple example is like the pharma industry or any biotech things where there's a long gestation period where it will take a long time to go ahead and work your way through all the various approvals that you need. And so revenues come fairly late. So, investors understand that and their timelines are longer. That's totally fine. So 5, yes. If you want to do 7 to tell your story, that's totally fine. Now, in terms of building out things, now you could, ultimately, you want to have a single P&L that shows the overall company. If you want to have a story that says, we have our initial product that has revenues, according to certain projections, and then we're going to build in a second product that then starts to come in year 3, 4, and actually overtakes the first one. First off, you should have in your revenue timeline, in your revenue line, you can break it out to 2 or more lines. This is very common. So let's say you have a product that has some software associated with it. And so I would ship my clickers and maybe I have some software updates. Those are 2 separate and distinct line items. And so I have revenue for product and revenue for software. So you could do the same thing and have revenue for product 1 and revenue for product 2. And you'd see the ongoing stream for 1 be kind of slow growing and revenue 2 would kick in. So again, that's why these things are adaptable. They're not, you don't have to conform to the general accepting accounting principles. You can change things in order to properly tell your story to a potential investor. And this is just one example of that.
Okay, gotcha. Thank you.
No problem.
Question. Thank you for a lecture. I know that you already answered for some similar questions that all these figures is assumptions, yes? But maybe you can give some advice, some tips how to convince investors that this assumption is, I would say, with maximum accuracy. Maybe we have to say something or use some sources or show some method of calculation or how to do it.
Yeah, there's a bunch of ways to do that. One is, your own evidence. So if you're interviewing customers is one. If you're citing third-party reports, and so you go on to Deloitte or Gartner or any one of these industry reports, you can take a look at that. It depends on the line item, but you can do more and more research, and the more research you have, some of that research will support you, some may not. You pick the ones that support you, throw away this other stuff. You provide this evidence. It's like going to court. You provide this evidence to your investor and you say, well, this is our estimate, but here's how we got there. We got there through 1, 2, 3, 4, 5. And you got to prove your case, and you look them in the eye and you try to convince them that you're real. It is a discussion that you have with them, and you just try to do your best. Now, most good investors will do their own homework as well. Mm-hmm. So they'll take what you provide. They won't take your word for it, and they'll go off and they'll contact their own sources and they'll do their own research. Usually, for the larger investment firms, you may be dealing with a partner, and in the back room, they have all these associates. So associates are like the brand new MBA students that just graduated, and they pay them nothing. They pay them, $10 an hour, and they keep them in the back room, and they work 20 hours a day. But those are the ones that take your numbers, and the good investors will redo all of your numbers. And they will take a look and try to figure out, using their own evidence, whether you are right or not. And they may not share that data with you. But just know that especially the more money you ask for, the more independent research that they will do.
Clear, thank you.
Yeah.
Rick, I have another question. Is it a good practice to tell investor that, I am not sure in my numbers, because everyone here is like a very early stage business. So is it okay to ask, let's spend $10,000 or $20,000 in order to validate this hypothesis? Sure. And if we reach these numbers, then come back to investor within probably a couple months. Is it acceptable, or should I just come and ask as much as I can get, like in a Silicon Valley?
Wow, don't Silicon Valley. There's this big legend about that we're crazy people and we just throw money around. No, we do our research too. Let me see what's the best way to answer that. So first off, in terms of asking for money, you can say something like, hey, we're putting together our plan right now. We're gathering data. We'll have our final plan available in 2 months. Here are the things that we're researching. You can share with them, what do you think about this? Here's my best guess now. We're going to look at this and this and this. They're people, you can talk to them and ask them for advice. And frankly, they appreciate it. So if you investing a lot of times is about a relationship. So if you establish a relationship with them before you're ready to ask for money, and you ask for advice and they give you some, and then you come back 2 months later and you say, oh, we took your advice. We looked here and here. Here's my results. They feel good about it, and their likelihood of investing is stronger. So there's absolutely no problem about saying, we don't have all the answers, here's the uncertainty. I'm going to do some more research. Help me, if you have some suggestions on what I can look at, great. You never know. There's a saying here that says, sometimes if you ask for money, you'll get advice. If you ask for advice, you might get some money. So, I don't know if I answered your question, but just in general. So if there are specific items in there that are uncertain and they have a huge impact on your P&L, you can point out those uncertainties. Say, this one we're not so sure about. It has a huge impact. We're going to do some more research. You look like you're an honest entrepreneur, and they will appreciate it. The good investors will appreciate it.
Yes. Okay. And this is probably another way to discover a good investor, probably.
Yeah. Because having a bad investor is terrible. It's like it could kill companies. And so what you want to do is to work with anybody, because you get to pick your investors. You want to work with people, and people you can work with and you align with philosophically. You'll know that after they invest, that you'll have a good relationship going forward.
Yeah, thank you.
No problem.
Hey, Rick. This is Igor from Berkeley.
Yeah.
Yeah, hey, thank you again for a great lecture today. It was a pleasure talking to you.
Where's your background?
Sorry?
You have to turn on your video. Where's your background?
Sorry, I was switched because connection was unstable.
There you go. Okay, good. Now I recognize.
Yeah, I'm still outside, so sorry for that. Okay, wanted to ask you one more question about valuation. So there are a lot of valuation methods that companies using right now. Yeah, like based on revenue, based on some OPEX, CAPEX, etc. But when we're talking about revenue, because we already talked to some potential investors and attract some investments already, valuation current stage, once you are like pre-revenue, it's a pretty hard and discussable thing. For now, we are using methods based on our competitors, like to compare what they have based on public information, and that makes some similar. But maybe you can suggest what's the better way here. Thank you.
There's tons of, so there, in fact, I give a lecture where I cover 20 different valuation methods. And some of them are for, later stage companies, some for growth stage, and some for early stage. The early stage is the hardest one because you're really guessing a lot, but you're doing the right thing, which is you take comparables. So you take a look at Crunchbase or Angel List or CB Insights or, any one of these research firms, and you see what other companies have raised in terms of what they've done. And you try to find companies that are kind of in your same industry if you can, about your same stage if you can. Take a look at the management team, see if they've got as many people, so on. So you want to compare something as similar as possible. So that's number one, is to try to find a pool of companies. And then you can apply metrics. So you might be earlier than them, or you might have a better product than them, or maybe have more IP. And so a lot of these valuation methodologies have the ability to adjust your valuation up or down, depending on your strengths versus them. And you can, I don't know if it's online, you can take a look, Google me, and you might find a valuation talk. Otherwise, there's some other ones. One's called the Berkus method, B-E-R-K-U-S, Berkus. So they're out there, but you're doing the right thing, which is comps and an adjustment to comps. And then maybe, Anastasia, if you want to have a valuation talk at some point, I'm happy to do that.
Yeah, it would be great. Can I just follow up your answer on this? You said to compare investors on competitors, yeah? But as you may know, as closer the company is to IPO, as more information, like public information about recently attacked investments, are in the network. For example, we have some competitor, and we have official information that they've attract some money on seed stage or Series A stage, and we know the figure, let it be 10 million. Yeah, but we are now on pre-seed stage. Should we can we somehow to adjust based on this figure, of figure of the next stage?
Yeah, the answer is yes. It's a little complicated. So let's say that you're trying to calculate pre-seed and you only have the data for seed. What you would do is you would kind of draw a straight line backwards to see where their company was founded, how much time you have, try to figure out, what a typical valuation could have been. Now there's going to be some data that's really strong and highly correlated. Then there's some data that's weak, and you kind of go, we're in this range. This one that you just labeled is kind of weak, but I can show you how to do that. But basically what you have to do is you draw a timeline. Their valuations here started at 0. You might be here on the timeline. Draw a straight line, see what ranges you might be in. It's a guess. It's like a detective game. You're just trying to find clues on trying to correlate. So that's only one data point. If you have weak data points, find 3 or 4 weak data points And if they all point to around the same thing, then you can present that to an investor and say, this is what we think.
Okay, got it. Thank you very much. Thanks.
No problem. No problem. Good question.
Rick, one more question from Ivan. We were talking about this, let's say, projected growth, right? But if we take some, let's say, example situation when we have a market where there is some dominant player and we want to take some bite of that market on some, say, niche sub-market, what kind of growth projection we may put on a table for subscription-based service?
Yeah.
Or is it just dependent on the how much money we can pour into marketing, or like how it's better like
often, yeah. Yeah. Do you have you launched a service yet, or are you just guessing right now?
I'm testing. I'm gonna launch it, and I gonna, let's say, run some first, let's say, campaigns and to measure some first metrics. But yeah, then if I'm gonna propose this P&L, I need to understand this projection. How will I grow, considering that still there is some dominant player, and I'm just targeting some, say, particular use case.
Okay, so there's a couple ways you can do that. First off, I would start with a bottom-up forecast, like we just showed you. Ignore what's going on with the outside market conditions and just think about how quickly you can grow, and then apply some sanity checks to it. So one of the sanity checks might be, okay, well, this company is now, $100 million. I'm just making up a number, $100 million company, and maybe you think you can get 20% market share. Take that number, test it against what you came up with a P&L to see whether you can go up or down based on your P&L. And then maybe take somebody else who has a similar circumstance. There was a dominant industry, new player came in, they were able to take this much market or grow this quickly. You can use that. That's another sanity check. So I would not start with me personally, I would not start with market share. I would start rather with your own estimates and then just try to see whether it makes sense. And then you take that same story and you use it to explain to investors.
Awesome, thank you.
I would have a question. I don't know if it's a question at all, but you were showing that we need to put this 5 years in P&L, yes? And that we should show that we are growing like 90%, 80% each year in products we're selling. Yeah. And for example, our product we're building is okay, we are building this product, we're selling it with a subscription, but it is the subscription is like $10 per user. And in P&L that we were preparing, we were showing that like we're planning like for the first test year, for the first year we're going to be on the market, we want to sell like 1,000 of subscription, and the next years like will be 10,000, 100,000, and so on. We'll just see how will it work, yeah, what results it's showing. And the thing is, if the question is like, if the subscription costs like $10, it's not a pricey product and so on. If we are showing like 1 year that we are selling 1,000 subscription, and the next year we want to sell 100,000 subscription, is it okay? Or we should like this growth should be like I don't know how to say, like would it be normal to show that we're starting like with 1,000 and then we want to grow like exponentially, or it wouldn't be looking good for the investor?
Yeah, so I don't know your product or your category. It might be possible. I mean, if you take some of the big crazy ones like a Facebook or Twitter, something like that, they had that kind of growth. They weren't subscription businesses, but maybe there are other examples. So the first thing that people will do is show me some other examples, maybe in other industries where this was possible. Great. So let's assume you have those. If you don't have those, then people are going to say, well, you're crazy talk. You're doing something no one has ever done before. So come up with something maybe more realistic. I don't know.
Okay, maybe I will give you tell you what we're building. It will be easier for you to answer yes.
Well, okay, and let's do that now. I'm happy to take a call separately just for everybody. Let me say that a typical high growth subscription business around here, there's something called 2T3D. 2T3D. You triple the first 2 years that you're actually in volume. So maybe you start with 10,000 a year. You triple, and then it's hard to triple every year. So then double. So a lot of the unicorns that are out there, if you take a look at what their revenues are for the first 5 years, they had this 2T3D model. And if you follow that, everybody go, oh, okay, well, that's already out there. Yeah. You might be able to do that too if you follow things. But you're growing 10 times every year. So that's very aggressive. But if you can show some other examples of how it works, then maybe it's possible. But let's not take up everybody here because we've got 60 other participants, or 27 now. And so let's take it offline.
Yeah, thanks.
Cool. Anybody else?
More questions?
That's good. All right. So we were going to run an hour and a half, and we're just short of that. So it's a good time to wrap up. If anybody's got one really great question, now's a good time. Otherwise, going once, going twice. Cool. All right. Please.
Yeah, Rick, thanks so much. It was extremely interesting, and I haven't heard, even though I've been myself studying mathematics, I haven't heard someone talking so simply about numbers as you did. So that's definitely impressive. Thank you so much. It was a pleasure listening to you, and thanks for your time. We'll keep in touch. I will follow up with the presentation and all the materials after this lecture with everyone who participated. And thanks. We'll talk to you soon.
Well, thank you. Thank you for all the great questions. Nice meeting all of you virtually. Hope to make it out to Ukraine sometime soon. In the meantime, have a good evening. Talk to you soon.
Thank you. Bye. Bye-bye.
Thank you very much. Bye.